You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The futures markets can be downright scary. Limit up, limit down. What the heck is RBOB anyway? Are they going to dump a truckload of soybeans on your front lawn if you click the wrong button? Come to think of it, maybe you should just stick to your comfort zone. Or you can break out of it with the Futures Rundown. The Futures Rundown is here to help you make sense of these scary markets. We'll analyze all the top futures trading activity, explore the ins and outs of your favorite products, explain exactly how futures work, and hear from leading experts in the futures markets. We'll even tackle all of your wildest futures trading questions. If it involves futures, then you'll hear about it on the Futures Rundown. The Futures Rundown is brought to you by T4 Futures and Options. Elevate your trading experience with the T4 Futures and Options trading platform. Whether you prefer desktop or mobile applications, T4 delivers low latency and professional grade functionality for both traders and brokers. Take advantage of theoretical sheets, strategy solver, MBO, advanced charts, and a suite of powerful features to enhance your trading strategy. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. And now, it's time to break into the futures markets. It's time for the Futures Rundown.
All right, everybody. That music means we are back with the newest addition to the network, turning Wednesday not just into Education Wednesday, but to another doubleheader here on the network, because it is time once again for the Futures Rundown, the program where we break down all the action in the underlying markets that we don't have a chance to talk about on most of our other shows here on the network. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the aforementioned network that is 17 and a half years old and not just going strong, but growing. Remember, another good reason you should be subscribed to the full network out there. Otherwise, you're missing out on new shows like this and all sorts of other fun. So make sure wherever you're listening to this, make sure you upgrade to the full network. Doesn't cost you anything, and it gets you access to nearly a dozen programs. If you like what you hear, throw a like, a star, a comment. All that does help, especially with a new show like this, brand new. Does help the algorithms point people our way. And of course, if you want to go above and beyond, you want to join us for awesome pro Q&A sessions, you want options oddities, beyond just what the network has in store for you, live streams, all sorts of fun, great giveaways. theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us on the old hot seat this week, I am pleased to welcome on for the first time here on the Futures Rundown, our old pal, Mr. Rich Excell, the clinical assistant professor at the College of Business over there at the University of Illinois. Rich, welcome for the first time to the Futures Rundown, sir.
Hey, Mark, thanks for having me. I always love to be on the various shows. Yeah, like you said, first time on the Futures Rundown. I'm looking forward to it. think we'll maybe cover a little bit different stuff, and so this will be exciting.
How's everything going over there at the Derivatives Trading Academy over there at the University of Illinois these days? Got any students tuning in today?
Thanks for asking. The first semester of the Derivatives and Trading Academy, and we're full bore. We're halfway through the semester. They've got a test tomorrow. So I'll tell you maybe on Friday how it's going, but it's going well. There's a lot of enthusiasm. Of course, a lot of fun market moves for us to talk about in class too. So that's always fun because we're getting them, not only teaching them about futures and options, but having them apply that in real time. So that's fun to do.
Oh, I like it. What's the first test on? What are we learning?
Well, the first test is on it really just kind of rehashing a lot of their knowledge on intro to futures and options markets, right? So they need to know a lot about profit and payoffs for options, but then we're kind of getting into a little bit about constructing futures curves and cash and carry arb and reverse cash and carry arb and how the cash flows work and how the timing of when or if you receive any asset when you buy the futures or trade the spot or the forwards, how that all works and logistically. So they have to kind of understand what we're doing before we really do it.
Oh, something that's near and dear to our hearts on this program, the whole subject of settlement and delivery and all that fun. Do you get a truckload of crude oil dumped on your lawn in the middle of the night? All that fun here. We tackle that on this show. Well, Rich, like I mentioned, when you're not busy educating the next generation of derivatives traders out there, you actually cut your teeth in the world of futures, I believe in FX. This is your first time here on the Futures Rundown. Give our audience a bit of an overview of your background in the world of all things futures, sir.
Yeah, for sure. Like you said, I cut my teeth at the CME in FX options and futures, Swiss franc, Deutschmark primarily. If anyone remembers the Deutschmark before the advent of the euro, that I was there, and then I moved into the world of global macro from there. And so in global macro, of course, we're trading and we're looking across all asset classes, all markets, and looking for the relative value opportunities from there. When I moved to the world of hedge funds in the multi-manager hedge fund space, there was a point when I worked with a team of people to develop in-house our own CTA or commodity trading advisor to look across kind of developing trend following algorithms to trade in the futures markets. And then, like I said, now I'm teaching about futures and options to the next generation. I call them, as I try to teach them, they need to be John Connor because the machines are Skynet, and so they need to be able to defeat Skynet. So that's how I motivate them. But I'm also working with a lot of companies kind of to help them, companies that are not necessarily, that are just retail oriented, et cetera, but that will have exposure to maybe ag markets, cattle markets, things like that, to think about how to develop hedging strategies for their businesses. And that's a bit what I do on the side when I'm not teaching.
John Connor, I like that. I can get behind that. Mm-hmm. I'm excited just thinking about it. And I'm also excited about our first segment. It is time to enter the trading pit.
It's time to break down all the action that's lighting up the futures markets this week. What's limit up and what's crashing and burning? Let's find out. It's time to enter the trading pit.
All right, listeners, let's get into it. Let's see what's lighting up out here in the world of futures this week. It's been a pretty active week out there. Let me run down some quick winners and losers, and I want to see what's catching Rich's eye out there. By the way, I know all the diehard future people have written in, there are technically no losers. If something's selling off this week, you can be short. I get it. I understand that. We're just using that parlance here on the show for fun, make it easy for people to understand upside and downside movements. But I do understand that you can be short these contracts as well. And I know Rich has some deep dives into some particular products he's been watching as well, so it should be a fun one. Well, let's do a quick run to the upside first here. Let's be optimistic. Let's do a little top 10, see what's lighting it up over the past week since our last show. Number 10 this week, we're going out to the world of crypto with the October ETH future. So near-dated ETH getting a little bit of a lift this week, up 2.5%. Bitcoin right above it, also the October future, 2.58%. Then let's sneak in a micro as well. That's kind of cheating. Bitcoin and Ether micros, both there at the bottom as well, 2.58, 2.61. Kind of the same thing, but we'll let those sneak in for this week, listeners. Then above it, we have a contract near and dear to our hearts. We just talked a lot about it last week on the show. It is Brent crude oil, the Gies contract up 3.06%. Crude oil very much on a lot of people's minds out there. Then above it, an interesting one here. Not one I don't think ever talked about on the show before. The pork cutout Gies future up 3.2%. So getting very specific, which I love. Then number 4, a product we name drop in the intro to this program, listener. What the heck is RBOB anyway? It's coming in at number 4, the November contract up 3.63%. And then we're going out to the New York Harbor out there, the heating oil, the Nove contract out there, 3.7%. And then back to our old pal WTI, the focus of the show last week, the November contract as well, up 3.75%. And then number 1 this week, our old pal Cocoa. Cocoa's been on the rampage of late and continuing that this week, the Gies contract up 4.6%. Rich, what are your thoughts on those upside movers? Anything in particular resonating with you, sir?
Yeah, I mean, a couple things that stand out to me. I mean, obviously, you look at WTI and Brent. I mean, that's the story to me that's interesting, because that I don't think that story has played out. We're seeing a little sell-off today because I think there hasn't been any imminent retaliation. And I think we're in the middle of holidays, though, in Israel. So I'm kind of expecting it. So I know it's always in everyone's mind to fade the kind of geopolitical risk moves, if you will. But sometimes something about this feels a little different to me, if you will. And then you throw in a little Chinese stimulus to the mix, and I think it's interesting to watch the price action in both Brent and WTI, because ultimately you look at it, and I try to track inflation pretty closely, and oil is a big driver of inflation. And we've got a CPI print coming out that everyone's going to be looking at, saying, hey, what's the Fed going to do, et cetera. Well, to me, keep your eye on oil, because if oil reaccelerates, that's going to pose some problems for what the Fed's going to do and for the rest of it. But then I think the other thing you mentioned, RBOB, I mean, that to me, ultimately, that is the number one commodity to watch, because it impacts consumers and it impacts the election. And here we are in a month to go to the election. Where the gas prices are probably going to matter to a few people when they kind of hit the button. So I think that one's kind of a super interesting one to keep an eye on too.
I thought for sure you're going to get all excited about pork cutout there, Rich. So you're surprising me here this week. All right, let's go to the dark side now, listeners. Again, you can't be short these. You could be doing well to the downside, but they are moving to the downside this week. Number 10, the Ultra T-Bond, the Gies contract off 3.2%. Number 9, we got our old pal soybeans going out to the ags. I have a feeling we'll be going back there in a little bit. The Nove contract there off 3 1/3. Then at number 8, we've got silver, the Gies contract, Uncle Mike's favorite here. Good old silver, the Gies contract off nearly 4% this week. Then keeping it in the metals, but going out to, as the Brits say, the aluminum, the Gies contract coming in right above it there, listeners, off 4 3/4%. And then we've got here number 6. Number 6, we've got Class 3 milk off 4.89%. Number 5, we've got good old soybean meal. Again, the Gies contract off 5.2%. And then number 4, high-grade copper. Going out to copper, getting base, listeners, in the metals. The Gies contract off 5.32%. Number 3, getting precious now, but still staying in the metals. I'm seeing a theme here to the downside this week, listeners. Platinum, going longer term, though. The Jan contract. That's interesting. The Jan Platinum contract off 5.8%. Then number 2, one of our favorite products here, just because it shows up with seeming irregularity here these days. Cash settled cheese, the Nove contract off 6 1/4%. And the big dog to the downside this week, listeners, Nat Gas, the Nove contract off 8.63%. So we've got some winners and some losers in the energy complex. Rich, I know you're all about the cash settled cheese, sir. Does it surprise you that it's off about 6 1/4% this week?
It really does. It does surprise me. And you got the Class 3 dairy on there too. I'm like, what the heck's going on north of the border here? I don't know what's going on north of Illinois, but that does kind of strike me a little bit. And I mentioned before that the Chinese stimulus, and you mentioned aluminum and platinum and all the different industrial metal, silver even that are on the downside this week. Like, it's kind of interesting that the metals, the industrial metals markets are kind of shaking their head and saying, maybe not good enough. So there's a few interesting movers, I think, on that list.
Well, let's check in really quickly on what's lighting up the tape here today, listeners, from a volume perspective. Let's see how much this correlates with that list we just broke down in terms of the winners and losers this week. This is our top 10 most active futures as of right now, coming into the start of the show today. we had to do a little bit of adjusting to this list. We had some micros, those pesky micros sneaking in there in the S&P and the NASDAQ. So we cut those out. Those would be somewhere in our number 2 and number 4 in the list otherwise. So micro, that's kind of cheating. It's not really 900, 700,000 contracts at the end of the day. So an adjusted, edited top 10 here for you. Listen, number 10, listeners, the Ultra T-Bond. We were just talking about that in our winners and losers for the week. The Gies contract, 169,000 of those on the tape today. Number 9, we're going out to the 30-year. That's the Gies contract as well. 212,000 contracts on the tape today. Number 8, going out to 3-month SOFR. Haven't seen SOFR popping into this list in a little bit, but it's popping in there today. The Gies contract, 238,000 on the tape. Then number 7, back to our old pal WTI, the Nove contract, 261,000 contracts on the tape. Number 6, the NASDAQ E-mini, Gies, going out to December. Everyone's fixated on near data these days, but it's December, lighting it up today. 274,000 of those futures on the tape. Number 5, back to the rates, the Ultra 10-year, 313,000 of those, the Gies contract on the tape there as well. Number 4, keeping in the rates, it's the 2-year, the Gies contract as well, 415,000. You can see how much of the volume out there these days is in the rates complex. Number 3, once we kicked out those pesky micros, we've got the S&P E-mini at number 3, listeners, the Gies contract as well, 587,000 contracts on the tape. And then 2 and 1, back to the rates complex. Number 2, the 5-year note, Gies contract, 629,000 contracts on the tape. And the big dog, as usual, week after week these days, it's the 10-year Gies contract, almost 1 million on the tape already, 963,000. So that one lighting it up. Rich, any surprises for you in our most active futures today?
No, there's not. And I wonder if there isn't a common thread kind of weaving through all that, where you see so much action in the rates market from the very short end to the very, very end of the curve. And I wonder to what extent the adjustments that we're seeing in the rate expectations are impacting some of those other things, like in the equities markets, and how much of that adjustment in rate expectations is coming from that move in WTI as well. So I wonder if there's not a common thread that's kind of weaving through all of that activity we're seeing, where ultimately it's tied into what's the Fed going to do.
Well, Rich, I know you've been taking deep dives into a lot of the products I just mentioned here. So let's hit on a couple of those now. In particular, listeners, if you want to follow along, Rich writes some fun articles over there at CME Group. Just go to cmegroup.com and look for his column. It's called Excell, E-X-C-E-L-L, with options. The most recent one coming out is Mining Economic Drivers for the Next Move in Gold. So gold's been an intriguing one to watch. Obviously, with the Fed coming out with their quote-unquote surprise half-point rate cut, that's obviously making gold have a little bit of a run, extending a run that's already been pretty good so far this year. But you've been looking at gold from a fundamentals as well as from a vol perspective. What's catching your eye in the gold market right now, Rich?
Yeah, I mean, how can you not want to look at gold, right? Here we are at all-time highs. It's super interesting to look at. I don't know if you saw the interesting article about Costco selling gold bars now. That was new to me. I hadn't heard that one until I saw it this week.
Yeah, I heard about that. And then they sold platinum as well, didn't they?
Yeah, and so and sold out in 46
and they
states.
sell out in minutes, I think. Yes.
Yeah. So clearly, there's a lot of demand or a lot of interest in gold right now. And
when you roll into Costco, Rich, you want $1.50 hot dog, and then $1,000 bar of platinum. That makes sense, right?
As you do, right? And maybe pick up a casket and some aluminum siding before you head out too. I mean, that's America, right? It doesn't get better than that. But so I'm like, I always ask yourself, what's driving it, right? And so I did one thing I didn't mention in my background in futures and in his futures and spot, but when I worked at Swiss Bank back in the 90s, I did trade gold and precious metals for a while. And so I'm like, okay, well, why don't I go back through and say what are some of the ideas that people typically will tell you why they're buying gold, right? And so let's look at that. Inflation. And that was in the article I saw about Costco. Inflation was the reason given. Inflation is a reason a lot of people would give you why they're buying gold. So I took a look at it. I looked at the price of gold versus the inflation surprise indices, both global and U.S. And as you look at it, you're like, okay, it's held for a long time. But since over the last 18 months to 2 years, gold's gone higher and inflation surprises have gone lower. So it's not inflation that's really, or inflation surprises that are really driving this move. So what else could it be? I'm like, well, central bank balance sheets, the growth of central bank balance sheets. Debasement of fiat currency. That's an argument that we kind of have heard for this, test of time when it comes to for gold bugs, the reason to own gold. And again, that kind of fit pretty well. The data fit pretty well until about COVID, when balance sheets exploded and gold kept up for a while, but then it basically went sideways for a long time. And since 2022, global balance sheets have been coming down, but in the last couple of years, again, gold's exploded higher. So they're really, the last parts of the move here, the last 2 years, really don't seem to be tied to what we're seeing in central bank balance sheets. Looking on like supply and demand, of course, anytime you're looking at the futures markets, we want to be thinking about that. But looking at the supply and demand data, it's really not the driver. Looking at retail interest in the ETF space, the shares outstanding, that's started to tick up, but just really recently, and had been falling for 4 years before that. So that's probably not what's looking at it. And real interest rates, we just talked about interest rates. I mean, that's always one that we would kind of think about. And if anything, the real interest rates are telling you gold should go lower, not higher. Global geopolitical risk. Look at measures of risk that we could across different markets. Economic uncertainty risk, VIX, if you will, MOVE index, just different measures of risk across markets. And there tend to be more on the lows, not on the highs, and gold's on the highs. And so, you're looking at it and you're like, don't seem to be a lot of those fundamental drivers. But at the same time, you look at it and clearly gold is trending. But as I was looking at the charts technically, what I noticed is that we had both all the daily, weekly, and monthly charts were all very overbought. And so then as I was kind of looking through, like, what's the trade here? Is the idea like, okay, I can't really find a good fundamental reason to want to hold on to this gold. Technically, it's looking overbought on all three periods. And so this sounds like something where I want to kind of fade it, if you will. And but I have to be cognizant of the fact that if I look at a position, look at the commitment of traders, and that's kind of at 5-year highs in terms of length, et cetera. So I want to do this via the options market, because it is trending, right? So you don't want to fade strong moves, right? And so you got to be careful on those counter trend moves. And you actually look at the C-vol market, and you look at what's going on in the options market, and vol has not been responding to this latest move higher, which potentially offers an opportunity to use a vol structure to fade the move. And so what I look to set up is what I would call a split strike fly. Some might refer to it as a broken wing fly, but for me, a broken wing fly is asymmetric in a little bit different way than this one. So I went out to November, said, okay, I want to get past the election, et cetera. And I'm just going to basically buy, a 25.50 put, sell a couple of the 25.75s, and then buy one of the 26.25. And so it's a little asymmetric, because if gold were to completely roll over and move a lot lower, I still make a little bit of money. It's like normally with flies, people struggle because you have to really pinpoint exactly where it's going to stop. But this one, if it keeps going, I still make some money. I have to pay a little money up front for that, but I don't mind paying a little bit of premium when I'm fading a strong trend and looking for a counter trend move, because it's still going to give me a defined risk. And I know, there's no free lunch out there. So I have to pay a little bit of money. So I figured that was kind of to me, a good structure to fade a move that is clearly technical in nature, where I couldn't find a good fundamental driver. But it wasn't really an imminent catalyst for it to roll over, other than the fact that maybe things are looking a little bit overbought here. And so that's kind of how I kind of came up with it, looking at through using the different tools available to us at the CME to try to analyze not only the moves that are happening, but how we might want to implement some of our ideas.
That's fascinating. I want to keep going on that, but we have more to discuss. So, I guess, Rich, you don't have enough time to just write the Excel with options. I guess you get bored. You have to put thoughts on your Substack as well, sir, because I noticed you were putting down some interesting thoughts on your Substack about the equity market and what we're seeing out there right now, kind of echoing some of the things I've been wondering about as well, but you actually have some good data to back him up here as well. He kicked things off, and his Substack is entitled, I'm Not Saying, I'm Just Saying, listeners. If you talk about the, I think, ridiculous number we had just a week or two ago, the non-farm payroll number blowing the doors off, over 250,000 when they were expecting about 150,000, so over 100,000 more. just crushing it by just about any metric out there. The markets, of course, as they are wont to do, kind of rallied off that. A lot of people thought maybe this was the sign that things are looking good, but even before that, going back to something that I mentioned earlier, something that I've kind of been mulling over, I think a lot of people have obviously been mulling over this as well, is the Fed taking that surprisingly aggressive move to go a half point. And they are not alone. A lot of central banks have been out there cutting and just easing very aggressively right now. In fact, you put together a chart here, and I think we'll have to tweet it out so our listeners can see it as well, listeners. But this chart kind of really puts it in stark relief, what I've been kind of trying to put my words on for a while here, which is effectively that this past September, when the Fed did their half-point cut, was the fourth biggest month for central bank policy cuts this century. Now, you're going back, obviously, century sounds like a long time. We're not going back 100 years, obviously, this century, listeners. But still, when you think about this last 24 years, nearly a quarter of a full century, a lot's happened. We've had, of course, the great financial crisis back in 08, 09. That was close to where we are right now, slightly higher. Then, of course, March of 2020, when everyone and their mother had to cut for obvious reasons. And then now here we are, September of 24, equity markets at new all-time highs pretty much every day, it seems like. Underlying stocks at new all-time highs across the board. And yet we have the fourth biggest month, if you count December of 08 and March of 09 as separate, even though that was all one big crisis lumped together. But if you take those months separately, this is the fourth largest month for central bank policy rate cuts since 2000. And usually, like you see in this chart, Rich, we're usually at some pretty dire moment in the global economy when we have to do this. And yet right now, it's completely the opposite. And we're just throwing fuel on this fire, sir. What are your thoughts on that?
Yeah, I mean, I think, as you said, it would probably shock a lot of people. I don't think they really understand. A lot of people don't understand the magnitude of what's been kind of going on in terms of global central bank policy here. We're talking about the expectations of a soft landing. Everything seems perfectly normal and fine. And, this growth is going to lead stocks higher. Inflation's coming lower. So, now we got top line increasing. We got margins increasing. And this is all good. Earnings are going to increase. You got to buy stocks, right? You got to buy everything. Then if that's the case, then why do we have such aggressive central bank policy? Like you said, we had the same number of cuts in September as we had in December of 08. I remember December of 08. It was pretty bleak out there. And then at the same time, we had the same number of cuts basically this month when everyone's telling you it's all good. And so, I mean, what that's leading to is we've seen it in a couple other charts that I showed is that liquidity is very, is sloshing around in the markets out there. And as a result, not surprisingly, we're seeing a level of positioning in, S&P futures, for instance, that is at, the highest we've seen in 10 years, which isn't surprising when if things are really as good as everyone says, and yet this liquidity is being pumped in, why wouldn't you own stocks? That is definitely the market to own stocks. It's all good. I guess one of the biggest concerns one might have is that everyone might be leaning on one side of the boat. And so then they always ask the question is well, what could go wrong, right? What could go wrong? It's all good. We got rate cuts coming, et cetera. I'm like, oh, well, maybe we want to look at what could go wrong. And what we've seen here maybe this week, the last few days, is that the bond market is starting to reprice a little bit of its expectations. If you remember, just past the FOMC in September, the bond market was still much more dovish than the Fed dots were in terms of where the Fed was saying that they were going to be. The bond market was much more dovish, expecting more cuts than even this year, the rest of this year, than what the Fed was telling you. And in the last several days, the Fed funds futures have moved back to where almost right in line with where the Fed dots are. And one might argue that the Fed dots are still too dovish, but at least the bond market's moved back in line. And we've seen that impact the 2-year yield, right? We've seen the 2-year yield move up, close to 4%, et cetera. And so that's something that's all of a sudden one of the three legs of the stool underpinning markets was Fed rate cuts. Is that starting to get priced out a little bit? The next one is inflation falling back to earth gently, improving the situation for consumers, for companies, et cetera. We get a CPI number tomorrow, so we'll get a little bit more on what's going on there. But I just started to look at what might be driving it. We talked about oil before. What other things have been big drivers? House prices certainly don't seem to be coming lower anytime soon. They continue to be positive year over year with what we're seeing with falling mortgage rates, with discussion of maybe giving people some money to buy a first home, some other ideas. Is that going to potentially lead to higher inflation, higher house price inflation? Then you look at the two big drivers out there are monetary policy. M2 growth has been going positive here quietly, pretty strongly for the last 18 months, and that's adding to that liquidity in the market. But that has tended, as Milton Friedman tells us, and as the empirical data shows us, leads with a year that leads to inflation, and it's been going up for over a year. So will inflation start to tick higher? And the last one I wanted to point out is like fiscal policy, right? And we've been running some good fiscal deficits for quite a long time now, and that also points to higher inflation. So absent whatever the number is tomorrow, when I look at the trends of what it could look like for the next several years, the inflation is starting to get me a little bit worried as well. And then the question becomes down to growth. I mean, you pointed to the strong jobs number. To me, growth. Employment is a lagging indicator. Housing is a much more leading indicator, housing and new orders. And so I'm more focused on those. And I think the jury's a little bit out on that. So I'm just, again, not trying to be a bear. I'm just trying to say everyone thinks everything's all good. What could go wrong? And these are some of the things I was looking at that could go wrong.
Yeah, I mean, I can't argue with any of that. I think this chart kind of says it all. It's one of those, a picture is worth 1,000 words there, Rich. And where can folks find your Substack if they want to see this for themselves?
Yeah, my Substack is called Stay Vigilant. So if you just go on to Substack, or if you go to stayvigilant.substack.com, you can find it. And I try to tweet it out as well, but yeah, you can certainly find it on that Substack platform, which I think there's a lot of great content on that platform too. So I'd encourage, if anyone hasn't gone on that, I would encourage you to go on there, not just to see read what I'm writing, but there's a lot of good content that's being put out there.
Well, speaking of good content, Rich is not done, listeners. Somehow he has time to analyze all this on top of educating all these students over there at the Derivatives Trading Academy over there. But I mentioned earlier, I said we're going to come back to soybeans and ags. We're going to do that right now, listeners. Another recent Excel with Options report that Rich put out entitled Navigating Corn and Soybean Volatility Ahead of the October WASDE report. And you might be saying, what the hell is the WASDE report? Well, it's coming out soon, October 11th. So we have great timing on this one, listeners. WASDE report, WASDE, stands for the World Agricultural Supply and Demand Estimates. And that's not enough acronym soup for you. It's put out by the World Agricultural Outlook Board, the WAOB. So ags just full of alphabet soup there, listeners. But that's what we're talking about. Obviously, a key volatility and price action driver in the ag markets. It's coming up in a couple of days. Mr. Rich, what have you spotted out there in the corn and soybean markets ahead of the WASDE report, sir?
Yeah, so if we go back to last month's WASDE, I mean, anyone who's been looking at corn and soybeans for this year, really kind of going into last year, it's been a relentless decline, right, for all of the year. And it's just been, like I said, relentless. It just keeps, it is just trending and feels super heavy for all the different drivers you can think of excess supply, lack of demand from overseas, et cetera. But after last month's report, which by all accounts was probably, at least particularly for corn, a lot of people's reaction was that it was a bearish report in terms of the expected bushels, expected yield, et cetera. So one might think that prices would have continued lower. However, what we've seen over the course of September is corn and soybeans, to a lesser extent, had a very sharp rally from the lows. And so, that's that trading instinct kicks in, right? When prices move in the opposite direction of where you think that fundamental might suggest, that kind of suggests that maybe there's something else going on. And sure enough, we see that the short in corn had been cut more than kind of cut in half over that period of time, and the short in soybeans was cut too, but to a lesser extent. And so you're definitely seeing some short covering. So I wanted to take a look at it. I mean, we talk about prices moving higher, even though with bearish news. I mean, that kind of goes back to that classic trading book, Reminiscences of a Stock Operator. That's a Jesse Livermore favorite. That when prices don't decline on bad news, it's time to go the other way, right? And so, is it the time to go the other way? And I took a look at it maybe through a little bit different lens, and I wanted to look at it from a relative value standpoint and say, what about going, instead of going long corn or soybeans or, on their own, what about looking at it on a relative value, long corn, short soybeans, how have that relative price looked? And if we look at over the last year, corn and soy has been kind of in a pretty tight trading range, the relative prices of them. But after that report, and over the course of the month of September, they've broken out to the top side of that 1 year trading range. And if you widen that out and look at it over 5 years, so while it looks extended on a 1 year basis because it's been kind of breaking out here above the top end of the range, it looks like it could have a lot further to go on a relative basis on a 5 year view. And so saying, okay, potentially is there a catalyst here for a continued relative move in corn versus soy? Because the short base is still higher in corn than soybeans. And so we saw short covering after last WASDE. Could this be a catalyst for more short covering and continue this move? Looking into the vol market again, looking at the CVOL, et cetera, corn CVOL is actually near the lows of the year. And soybeans are near the highs of the year. And not only that, but comparing the two to each other, historically, corn almost always on the CVOL level basis, almost always trades above soy, if not well above soy. Like sometimes that spread can be up to 10 points. And they're trading at pretty similar levels, actually. And so that kind of, again, perks me up like, okay, maybe there's an opportunity to be long corn options versus soy options as well. So there's a directional bias. There's a volatility bias, perhaps. And we know looking at it that they're pretty highly correlated products. And so that's one thing you want to make sure that when you're doing something on an RV basis that there is a correlation between them. And then CME's got a great tool, the Event Volatility Calculator. You can see what's priced in, what's expected. There's really no expectation for a catalyst in the soybean markets using the Event Volatility Calculator. And if anything, in the corn markets, it looks like they're pricing in lower volatility from the catalyst. And so that all kind of made me think that it's time to express a directional and volatility view relative value. So I decided to kind of go long corn options and short soybean options. And I did it on a 3-to-1 basis where I'm long 3 corn options and short 1 soybean. I looked at the upside calls on each. And of course, in that size scenario, obviously, if as long as the correlations hold, if everything moves higher, I'm going to do better because I've got more leverage to the upside because I'm long more options. If they both go lower and it's a complete fade, I'm net premium neutral, so I'm not going to be losing any money on that. The risk is, of course, that corn sits or kind of maybe goes a little bit lower and soybean takes off. That would be my risk. I think given the setup, looking at the technicals, looking at what we've kind of talked about fundamentally and looking at the kind of the short base, I felt like that was a risk that was worth taking. And so that's kind of how I was looking to set it up. I imagine not a lot of people are always looking to play RV trades in corn and soybeans via options. And so I thought it might be an interesting thing to throw out there.
Fascinating deep dive into multiple contracts this week, listeners. We went into ags, equities, a little gold for you, all sorts of fun in the trading pit this week. I was going to get into some symbology and some contract month crows, but kind of running a little long. So tell you what, we'll save that for your next appearance, Mr. Rich. Instead, we'll get into a little bit. You are the educator, after all. You can educate us all on why these contract month codes make no sense in futures, as we keep on rolling into a little bit of the old futures free-for-all.
Ring the bell. It's time to take on all comers in an epic Q&A battle royale. All questions can enter, but none can leave without an answer. It's time for the Futures Free-for-All.
All right, welcome to the Futures Free-for-All. This is, of course, the listener engagement segment. You folks get to sound off on what's floating your boat out there, what's catching your eye. And actually, Rich, I wanted to get your thoughts on the results of our recent question of the week out there, because we were just talking about government stimulus out there and Fed stimulus out there for the market, and the fact that we're at all-time highs, and also the fact that we have, and I'm not sure if you heard, there's an election imminent coming up in the next month, so that's certainly a catalyst for a little bit of volatility, a little bit of concern out there in the markets. We asked our audience this time a week ago, the election is looming. What is your trading plan through election day? Gave you 4 different choices. Stay long, stay the course, so pretty much just stay put, don't change anything. Or get flat, go to cash. Maybe you're feeling a little bit nervous out there right now. Or you're feeling very nervous, you're getting short, or you're just hedging your portfolio pretty aggressively. Or maybe you're just keeping things bite-sized, you're just trading small and staying intraday. And Mr. Rich, it was kind of a tight fight most of the week. At the end of the week, stay long, stay the course ended up taking it with 39.3%. Followed by 32.1% saying they want to trade small, keep things intraday only, not really biting off a lot, certainly not a lot overnight or not a lot on the weekends, which has its own risks these days. And then 21.4% said they want to get flat or go to cash. And then about 7.1% are feeling really dire out there right now. They say they want to get short or hedge their portfolio. Rich, I'm curious, what are your thoughts on what our audience is doing heading into the election, sir?
Well, I mean, as you said, it's tough not to stay long given the liquidity that's been pumped in. It does worry me a little bit that everyone's kind of leaning one way, but doesn't worry me enough to want to kind of go short. To me, I guess I would have probably fell somewhere between trade small and go to cash. And I don't think of going to cash in terms of a nervousness get flat. I think of it, especially near the election, of being in cash to have that dry powder to take advantage of any sort of obscure moves you're going to get coming out of the election, which I think with all the uncertainty going into it, that there's a possibility of that. So I like the idea of dry powder in the days that follow and to trade any opportunities. But I guess to me, I guess if I had to vote, I would be in the trade small intraday only, with the idea that I'm going to kind of keep things in cash in and around that election to wait for the fat pitch, as they say.
We may have to adapt and update that question in the coming weeks. We just had the folks from Interactive Brokers on our Pro Q&A yesterday, and they were talking about they just got approval to list binaries effectively on the election. So you can go to their platform right now and effectively put on, they're not really futures, they're effectively binary options, listeners, on whether you think Trump's going to win or lose, whether you think, Harris is going to win or lose. Almost every race you can think of in the country, they have listed contracts. I know this has kind of been the holy grail for a lot of platforms for a long time. I know the folks at Nadex years ago were trying to get this, and they never thought the CFTC would really approve it. And here we are, Rich. It's a very different era. You can actually trade on the election now on listed contracts on maybe not exchanges, because they're not doing them CME, but they're doing them on a platform that people have actually heard of, like IB and others. So I guess you can all literally trade the election now, Rich. So maybe that's something we need to factor into our calculations going forward. What do you think?
Yeah, I mean, for sure. I think for a long time, even kind of going back a long time when we had the Iowa political exchange or Iowa betting exchange or something. There was that kind of I think University of Iowa might have done, where they had those kind of betting markets around elections. To me, there's a lot more information in these kind of election betting markets than there is in any sort of surveys or polls you're going to get, because if someone's willing to put some money on the line, I'm more willing to listen to that opinion than what someone says when they answer someone asking me a question. So I think there's a lot of potential interest and information in those markets.
Yeah, I was just checking the volume yesterday, and they haven't been listed that long, and already a little north of 250,000 of the binaries on Harris have traded, about 80,000 on Trump. So I don't know, read into those volumes what you will. Obviously, you can go both ways on binaries, yes and no, but I think most people lean towards the yes side, kind of the overside. So intriguing data out there, listeners. And Rich, if folks want more intriguing data, they want to check out your Excel with Options column or plug your Substack again, have at it, sir. The floor is yours.
Yeah, for sure. So if you go to cmegroup.com and you look on the education page in the insights, you'll see my Excel with Options, and I do a biweekly piece on the various markets, and then I do a monthly ag special piece around the WASDE reports. And each week, or every other bi-week, I should say, every other 2 weeks, I'm covering a different market of CME product, and so just trying to use that to get people thinking about the ways you might want to use options instead of futures to implement some of your ideas. And then, like I said, my Substack is called Stay Vigilant, so stayvigilant.substack.com. And on Twitter, you can find me at Excel Richard if you want to look for me on Twitter, or X as it's called. So any of those places, I try to kind of share out stuff on a daily, weekly, bi-weekly, and monthly basis.
A lot of great data, a lot of great analysis there. We just scratched the surface of it on the show today, Liz. I think you can see there's a lot of great data waiting for you. So make sure you're following Rich and checking out his articles on those various platforms. While we're checking out platforms online, make sure you check out our friends over there at ctsfutures.com. Great futures platform. Also an options offering there as well. So if you're thinking about dipping your toes into the world of futures options, they got you covered there as well. ctsfutures.com, the place to go to learn more. We have to get on out of here for today. Back again tomorrow with our usual Thursday doubleheader. First off, we're going to be on the option block with our friends over there at SIBO, then back with This Week in Futures Options, talking about the options side of the futures market with our friends over there at CME. Friday, of course, volatility views, and we're back one final time exclusively for our pro members, coming back for a little bit of options oddities. You can find that for yourselves at theoptionsinsider.com/pro, the place to go to learn more. And then we're off for the weekend, and then we're back again next Wednesday, another episode of the Futures Rundown. Stay safe out there, everybody.
Thank you for tuning in to the Futures Rundown, proudly sponsored by T4 Futures and Options. Experience the T4 Futures and Options trading platform with its seamless desktop and mobile applications, low latency, and professional functionality tailored for traders and brokers alike. Take advantage of T4 Theoretical Sheets, Strategy Solver, MBO, Advanced Charts, and much more. Empower your trading journey with T4 Futures and Options. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.